Most retail traders treat every hour in the market the same way. They'll trade the London lunch the same way they trade the New York Open. And then they'll wonder why the market suddenly feels dead or unpredictable. But markets behave differently throughout the day because different participants come in. Liquidity changes, volatility changes, and expectations change. The same setup can perform completely different depending on when it appears. So this video isn't about strategy. It's about understanding the rhythm of the trading day. When markets tend to expand, when they tend to consolidate, and when the conditions are usually low probability. If you start understanding that, trading starts to make way more sense. It's not just about price, it's time and price. The FX market trades 24 hours a day, but participation is not evenly distributed. Different financial centers dominate different parts of the day. You have the Asian, the London, the New York, the Australian, and each session has a different behavior. Asia is more slower and it's more range oriented. London is where the volatility starts to increase, and New York is where major continuation or repricing often happens. Then you have the overlaps, the London-New York overlap. That's the one I personally like to trade. It's usually where participation is the highest and it's where the cleanest moves happen. This is important because the markets move more when participation increases. Expansion usually comes from new information, new positioning, or large pools of liquidity entering the market. The Asian session is often where the market starts building structure for the day. Not always, but very often, volatility compresses, ranges form, and price spends more time rotating rather than trending. Doesn't mean that Asia is useless, but it gives you context for the upcoming trading day. A lot of traders make the mistake of expecting expansion during conditions that are structurally designed for compression. That's where the market is only moving 20 to 30 pips and it's repeatedly reverting to the mean. You probably shouldn't be trading it the same way you would trade a New York momentum environment. London is where the market often starts expanding. Participation increases sharply and liquidity starts to increase, and there's a lot of institutional activity increasing as well. And expectations begin repricing quickly. That's the most important part. And that is why London creates some of the best opportunities in Forex. It doesn't always trend, but it's when expansion becomes most likely. This is a key distinction because traders think in probabilities and not guarantees. A lot of the strong moves start from a sweep of one side of the range, a failed continuation, there's an aggressive expansion the other way. And that's why session timing matters so much. The Asian session times I like to use, it's the Asian kill zone during 8 till 12 New York time, so 8 p.m. to 12 p.m. The London Open kill zone is from 2 a.m. till 5 a.m. New York time. The New York session, the open kill zone is about from 7 till 10, but there's a bit of discrepancy there. Some people like to trade in the later part of that kill zone because you tend to get a little bit of manipulation between like 7 till 8. This is where a major shift in conditions is introduced, especially around 8:30 New York time, because that's when the news embargo finishes and news is released. At this point, the market is rapidly repricing expectations. There's inflation, employment, unemployment, growth, interest rates. Because FX is heavily tied to macro expansions, volatility can increase dramatically. Yeah, you also have the London-New York overlap. This is the highest participation window of the day. It's got the highest volume, trading volume, and market volatility. So higher participation generally means you get cleaner expansion opportunities. Price can move very fast, but high volatility does need a sustained direction. Otherwise, it becomes quite chaotic. You get those sweep and destroy conditions where it takes a low, takes a high, takes a low, takes a high, repeats. So how does a daily candle form? This is the most important thing you need to know about intraday structure. The daily candle forms progressively throughout the day. You have the open, the high, the low, and the close. And parts of this candle tends to form during these sessions. So what I like to use is the New York midnight opening price as the reference point. So you can mark that out on your chart, 12 a.m. New York time. Just draw a line and then you can kind of visualize where is the accumulation happening, the protraction or the manipulation, and then where's the expansion. So the day opens, price will begin moving one way, probing, sweeping liquidity, and then later in the day it will start to expand, and that's the true expansion for the day. And then finally you might get a little bit of retracement back into the range, and then it will close. Sometimes that gives you a very clean directional candle. Sometimes you just get expansion in one direction followed by a full reversal, and sometimes the market just chops around all day. When it's chopping, those are the lowest probability conditions, but the midnight open price helps you to see that a little bit better. This makes intraday trading a lot easier because you start thinking about like isolated candles, 4 hours, 1 hours, and you start thinking about how is the daily candle going to form, how you can use it alongside your higher time frame buyers. You think about liquidity, session driven behavior, when to position yourself, when to even like look at the markets and engage with it, and when to just back off. The market is essentially building a narrative throughout the day, and then your job is just to identify what is happening when is the expansion happening, when is the trend continuation happening, the reversal, the chop. And the more you trade it, you start to see specific sessions on specific currencies have repetitive behavior. You can kind of see like where on euro dollar, for example, the London has expanded, it's left behind specific characteristics. You can kind of use that to frame your New York expansion or your New York reversal. On low probability conditions, the majority of your losses will be here. Like forcing trades during these kind of conditions is a big mistake that many people make. The key skill is identifying what price looks like during these conditions. You'll see repeated reversals, failed expansions, overlapping ranges, and no sustained price movement in any direction. If the London can't expand and the New York can't continue, this is the sign that there's a good chance the market is not offering good conditions for the day, which is normal because not every day is a trading day. Sometimes the highest quality decision is reducing your expectations and knowing when to step away from the charts and just leave it for the day, and not to force trades during these kind of conditions. Now later in the day, around 3 p.m. New York time, is when you get the bond market closing. This is big for forex markets. Dollar pairs start to drift, compress, and it slows down significantly. I wouldn't want to enter a trade anytime after 3 p.m. because it's just so slow. You won't get anywhere. You'll be holding it for way too long because the participation decreases, liquidity changes, and all momentum is just faded out. Moves can happen, but it's not favorable for intraday trading. Might as well just save yourself to trade these session opens, the London Open, the New York Open. Not every hour deserves the same level of risk and aggression. The goal isn't to predict every move, it's to understand what kind of environment the market is operating. Once you start to get familiar with when expansion is likely, when participation is increasing, and when conditions are just low probability, you start to be able to make better decision making and your trading will improve dramatically. So stop treating every candle the same way. Asian, London, New York, they're completely different sessions with completely different characteristics. Trade it enough, you'll start to get familiar with them, and you'll know when is the right time to take a trade, when is the right time to be aggressive, and when is the right time to just take a step back.